Dear colleagues, good morning. We will do a totally English language event this morning. Thank you very much for coming. And I see that there are more people today than at some of our previous events, because the topic today is quite hot and very demanded by our CFA audience. And of course, the reason is the number of controversies in the opinions and in the forecasts that we are facing over the past 2 years. We all see that the real estate market, as well as the Russian economy as a whole, has been going through the difficult times over the past 2 years. And real estate probably is one market which will show very clearly how investors feel differently about different countries in Central and Eastern Europe. We can see that in 2015, although investment volumes in some parts of real estate have increased compared to 2014 in Russia, still they are much lower, particularly in dollar terms, than in previous years. In the same time, in the Central and Eastern European countries, investors have been much more active. There have been more interest towards all areas of commercial real estate and real estate as a whole. So today I'm very pleased to welcome our honored guest, the specialist who has been working with the real estate market in Russia for many years. And I will present and give the floor to Holger Müller, who is head of the real estate team of PricewaterhouseCoopers, working on the Russian market. Thank you.
Thank you very much. Yeah, good morning, everybody. Happy to see so many people here. My report today is in real estate research we do once a year together with the Urban Land Institute, and this already for 12 years. You will see it covers Europe in general, and we give a good comparison over the most important cities for real estate in Europe, including Moscow. We have then added to this our own research. This year we have done for the first time a benchmark research, interviewing more than 30 of the leading real estate investors and developers in Moscow. And the second part of my presentation is about the research we have done with this just on the Moscow market. I don't know what your roles are here today. I think the first part is more interesting for people who are investing money and comparing the market here with the markets abroad. The second might be also interesting for those who have to look after rental rates for their offices, logistics, and so on. Perhaps one thing interesting is that we're doing this research report. I don't know if Sergei Belashapko has done it today. Perhaps he's here, not is coming. Otherwise, I have to do the discussion on my own with myself. As I said, we're doing this research for 12 years, and we are interviewing every year around 600 people all over Europe, and these are mainly the key decision makers in all the big real estate funds, the brokerage houses, and then other people who play a leading role in the real estate market. When I did this presentation, I think 3 years ago, in the report we had included as well, which I found very interesting, a comparison. They compared the results of the forecasts done by these 600 people against the real results of the economy. So if they said, we think we will have growth next year, they then checked, did it really happen or not? And they compared then this forecast also with the forecasts done by the European Union among 20,000 consumers on the market. And it showed that the 600 people in the real estate market were much better in forecasting the future than the 20,000 people interviewed by the European Commission. And I think the main reason is here that real estate is simply very long-term business, and therefore people in these functions have to know better or can make better forecasts about the future than the normal person on the street. Still, I found it interesting that the 600 people are better than the 20,000. We see here every year we ask people to rate the prospects of 28 cities all over Europe, and we come then to general numbers, which are between 0, which is extremely bad, and 5, which is very good. And you see here, you see here how this is changing over the years. Here, of course, the big crisis after the demise of Lehman Brothers. And now we are very, very strong, stronger than even much stronger than even before 2007. And this is one of the main stories in this report. So in general, the situation is very good. You see that business confidence, you still have 37% who think it's improving, 53 at least stays the same, only 10% thinks it will get worse. It was last year, the same 10% is slightly a bit more cautious this year than in the last year. So the number of people who think it will be better has slightly fallen, but still only 10% think it gets worse. Business profitability is a similar picture. Here again, that only very small part thinks it will fall. And the same for the headcount, which is good for everybody looking for a job. You still have 38 people who think they will increase the headcount, and only 7 think they will decrease. What we see here a bit, last year people were extremely positive. I think from the answers, you just have the impression that people become a bit scared of their own optimism. And as the European Central Bank is flooding the market with money, and a lot of this money goes into real estate markets, people just become hesitant to believe that this will always go on like this. We then have, here we have the biggest issues impacting the real estate sector. I think what is positive here is that most of people think that the European economy will stay the same or improve, with a big part of thinking it will improve. But of course there's a lot of other problems which we still have, political uncertainty. People expect that finance costs will rise, although since we have done the report, they have rather fallen. And then one issue which will come up later is the availability of prime assets. And this is a big problem, and it will show up quite often in the report, is that most of the institutional investors, they are looking for this so-called prime assets for office centers, like the one we have here, in the top locations and the top areas of the top cities. And these are increasingly difficult to come by, as a lot of people are investing into real estate. So you see again here the biggest issue they have right now is the shortage of suitable assets to acquire. Then otherwise, an important issue which does not play a big role here in Russia is sustainability. This is all things concerning energy savings and green building and these sort of things. And what I always find interesting with this, we're doing these discussions of this report in Russia already for 12 years. And I think the first time 8 years ago, somebody stood up and said, listen, what's about green building? Everybody, people said, forget about green building, we have other problems. So I think still, I've seen some buildings are now certified green buildings in Russia, but in general, this is still not our issue. We have other issues. Interesting as well that you see here forecasts on inflation and interest rates. You see here that I think you have 38% who think that inflation will only slightly increase or stay the same, and only 3% think it will increase strongly, and then of course the same for the interest rates as well. So more or less people expect the situation to stay stable, which is small wonder in view of the policies pursued by the European Central Bank. This is interesting, I think, that the availability of financing, people expect that equity for buildings will rise again available, 40% will rise somehow, and 35% stay the same. Only 9% think it will fall. These are the same 9% we see almost everywhere here, who are a bit negative. Refinancing for new investments, same picture. Only 6% think it will go down, so the banks are flooded with money by the central bank and have to look for some places to invest, and real estate is one place where they're very happy to invest. And you see here also development becomes increasingly a hot topic as we don't have completed real estate prime assets available, development, and those which are available produce very low yields. People are increasingly interested in going into development. I find this chart very interesting because if you look at the yields in real estate, I mean, they say here the Euro property yield, which is an average, is somewhere at 4.5 right now. You would get, if you buy a prime office building, say in Munich or in Berlin, you would get something between 3.5% and 4% unleveraged. After all costs, you're probably somewhere at 3%, again unleveraged, which is not a lot. At the same time, in view of the fact that Euribor is here somewhere at 0 right now, and that you have even on the German long-term bonds, you had negative yield on 10-year bonds recently. Then these 3.5 are of course very, very impressive measures still. And you see here just before the crisis, it was almost the same, the Euribor yields and the real estate yields. So we have now a difference of 4.5%, which is a lot. And sometimes when we're talking to people about yields available in real estate, I think people are not aware that compared to the overall interest rate environment, these are very good yields which you can get here right now. We also have to see, which of course makes a big difference, you get I know the German market most because I'm quite active there. You get refinancing of completed office buildings, you pay about 2% for 10-year loans. Mortgages, you get 10-year fixed rate right now at 1 to 1.5%. So financing costs for debt financing are very, very low, and therefore leveraged, you can still have very impressive yields. We're coming now to development, what I also mentioned before, that increasingly people are looking to invest into development in order to get the prime assets which otherwise they would not get, or in order to get higher yields. As I said, I'm quite active in looking at the German market as well. We're looking right now for Russian investors at development projects, which of course are much more risky. And there we're talking about financing mezzanine loans, so which are secured after the bank financing. So we're talking about 12.5 to 15% for the equity investor on a 3-year horizon. Of course, which with much higher risk, because very often you come in when the land plot is bought. So it is not, I mean, normally you would expect that you have the right to build because of the zoning in this area, but you don't have a building permit. So it comes with a couple of risks, but a lot of people are happy to take these risks because otherwise the 3% or 3.5% they get in completed buildings are not interesting enough for them. It is also, I think, interesting. We have the big German open real estate funds, which are now flooded by German retail investors with money who will try to find a place for their money. As now even the savings banks think to ask for a negative interest rate on savings which you keep with the savings bank, because they have to pay interest to the central bank if they keep money there. So people try to get out of their savings accounts, put it into real estate funds. And a couple of the big German real estate funds have closed down now and said, listen, no, we don't take any new money because we don't know where to invest it, which is a situation which we never had before. What we also see is that increasingly people are now looking at alternative real estate assets. This is, for example, student housing, which is a big issue right now, retirement living, we have this sort of private storage facilities, these city boxes. So there's a lot of things that people are looking at. We see here the most active real estate markets. I think this is a good overview. London is always the most important market in Europe. This is somehow the gold standard of Europe. We had last year, for the first time, Berlin making to the second place, which is very unusual because for the last 20 years, Berlin probably was the ugly duck in European real estate markets. Paris is rather weak. And then here you see the other cities coming up as well. We have here an overview over the cities in general. So you see here the outlook for investment to completed buildings, and then the outlook, how attractive is it to invest into developments in the respective city. And you see here Berlin at top, Dublin, which has shown a very strong performance after being very low 3 years ago, and Moscow, unfortunately, at the last place, like last year as well. I just taken out a couple of highlights from this list, which I just have shown to you. You see, we start with Berlin, which has been #1 last year and is #1 this year as well. I think there are mainly two reasons for this. So far, one is the strength of the German economy, which is right now one of the strongest, or in the European Union of big ones, certainly the strongest in Europe. And secondly, you have this special factor in Berlin, which is regarded as being strongly undervalued. And the reason is here that compared to the other big European capitals like Paris or London, Berlin was extremely poor already before the fall of the Iron Curtain. And then when it was reunited with East Berlin, of course, this also didn't really help. So it's quite run down, still quite cheap. But now increasingly, somehow a lot of the functions of the capital in Germany were taken over by Munich, and this is changing now. A lot of money is flowing into Berlin, and that's why people think it's the right time to go there. So there's really a crazy situation. It's also funny, I mean, you have the residential sector, which is extremely strong in Berlin, but you also have now the very strong rental results, which shows that even also the real economy is getting off. Athens was #5 last year, as everybody thought, okay, they're bailed out and the situation will improve. But this has not worked out. It's back at 27th place, as people were found out that it will take longer to fix the situation in Greece. We have London, which, as I said, is the gold standard, which fell from 10 to 15. And here it's mainly the reason that people think it's just overvalued. It becomes a bit dangerous to invest there. And that's why they become more cautious. We have Paris, which is weak. I mean, normally Paris is one of the hotspots because it's, after London, the second biggest single real estate market. And France, very strong economy as well. But it is here mainly political problems and a rather weak economy, which make people a bit wary. Also, tax legislation in France, that people are wary of investing there. So it's just made it slightly up to 22nd place, but this is very low on the European standard. Munich is here slightly up from 11 to 10. It is seen as a very strong position, but here again, it's also quite expensive already, and therefore people are a bit more cautious. Vienna is overvalued to some extent, therefore it's quite low, and Zurich is overvalued, and also Zurich is very small, and it's mainly local money, and therefore people are less interested to go there. And then here Moscow, this mistake here, I mean, this was in 2014, it was #13. Last year it was #28, and this year it's 28 again. And I had done a lot of the interviews which we do in Moscow on the market, and I think at least people I spoke to were somehow, I think mainly they thought, okay, with the first crisis, we have seen this all before, and a lot of them thought it has bottomed out. But the picture is not really clear, as I show you now. You see here also, you see the outlooks for Moscow over the last years, how it always went down, up, down, up. It's very impressive. It is almost from one of the top spaces down to the lowest, top space to the lowest, and now it's there for the first time in the first 2 years in a row on the lowest place. And also before we had Moscow was always seen as very attractive for developments, which is the red line, because there's still so much to be done in terms of quality real estate space in Moscow, but for development as well, it's on the last place now. I come now to our benchmark study, which we have done from PwC this year for the first time, interviewing more than 30 of the leading real estate players. Unfortunately, the picture here is not much more optimistic. We have these are the yields on the current yields on real estate transactions. We had been for offices in Moscow at 8.5%, 2013, and somewhere at 10 to 11, warehouses 12 to 13, and for retail as well. And the real estate investment volume has declined. I mean, we had been last year, we had been 50% down compared to 2013. And I think this year we don't expect a lot to happen. I think what is at least slightly positive, we see more of rich structures now looking for real estate deals again, very often with difficult ideas about pricing. So you see people who are ready to invest into the Russian real estate again, but this is mainly oligarch structures who try now to buy something cheap, and therefore normally it is smaller buildings. When you don't see interest for the big $200, $300, $400 million assets, but smaller things between 10 and 30 million, there is certainly interest. But people are always looking for the distressed assets, and in my opinion, this is very difficult, because either things are distressed because they are bad, and then they are really not worth much, or they are not distressed and then they are real money and people don't want to sell them for cheap. And we had the same problem during the last crisis. So this is one of the issues for the Moscow real estate market. Here you see investments into different areas of the real estate market last year. Office, as always, the strongest, of course. Last year retail was bigger, but normally office is the strongest one. and here you see what people think is attractive right now for investments, and where they see an oversupply. So the most interesting one is residential, and the office sector is seen as extremely weak. And I think here as well, we still have a lot of oversupply. Vacancies are stable or slightly rising. We see right now movement from people moving from Class B offices to Class A offices at the same price or even lower rents in order to improve their rental situation. And I have to say I'm a bit skeptical if we have found the bottom in the real estate market as well. We see here the rental rates. I mean, these are the ruble rental rates. So they are down, and of course in dollar rates they're even much further down. Retail is still more okay, but offices are difficult. And here you see again what the players are expecting. So in general, a decrease of prices is people expect either they stay the same or to decrease for most parts of the real estate market. And this is my last slide, which is a bit sobering. I think we asked them, will the market return to pre-crisis levels? And then we have only 4% to say yes in 1 to 2 years, that they might be back. We have 42 who say yes within 5 years, which is still quite a long way. 15 in the long term, and 35 say they will never come back to the prices before the crisis. I think this slide is a bit overdone. My view is that we probably have something like bottoming out over the next 3 years, and that's what I hear from a lot of people. And then we see how they recover, but they will certainly at some point they recover. And to remember the slide which I had before, where you see just how quickly situations can change. So one should never lose hope, of course. You find the report from ULI under this here on the website. And who is interested in this, I strongly recommend to look at it. It's very easy to read and it's fun to read, I think. So it doesn't take you more than an hour or two to go through it. Then you have quite a good overview over the real estate market in Europe. That's already all from my side. Thank you very much for listening, and if you have any questions, I'm happy to answer them if I can answer them. Thank you.
Yeah, so if we can briefly come back to the slide with European yields compared to interbank rates. Yes, so are these yields adjusted for property taxes? Because at times people quote high yields, but then it turns out that...
No, normally they are in Europe you have the net yields, which is after all the costs.
So
tax would be borne by the tenant.
So just to clarify, usually yields are quoted on a triple net basis, ex VAT, utilities, and maintenance. So VAT and taxes go together then in this category, right? This is really the net which you get.
Okay.
I have a question. So, what the main changes foreign investors see when they trying to come to Russian market to buy the assets or to invest? So, what Russia shall improve here?
I think when I see mainly two issues, and one is real and the other is made up. If I follow in the European press, for example. And I think the one which, in my view, is made up is the property right issue. I mean, it is true to some extent. We had this. There's this idea still that if you buy a building in Moscow, somebody can take it away from you. And this is true to some extent. I think that if you buy land plots, I mean, this has happened to me in the Moscow Oblast. Really, somebody has taken it away from me in a not legal way, and was a lot of problem. And this has come up very often. I think for office buildings in Moscow, if as a big European investor, I don't see this risk. Further on, you had recently, 2 years ago, I think, these issues with the property tax, which went up very strongly and was a strong hit for investors. And there had been an outcry among European and American investors. So this is an issue which goes a bit into this property thing. You're not as safe as possible. But the main issue right now is the political situation, of course, that from the outside it's unclear how it all will develop. And that's why right now, at least for the big European and American investors, they even don't look at Russia. If somebody would come to his investment committee and say, listen, I have this great opportunity in Moscow, people would say, leave us alone, please. I mean, they would not look at it.
Thank you.
Perhaps also a last thing, of course, we have now a problem with leverage in Russia, because interest rates, long-term interest rates, if they are there, I mean, you almost don't get probably a 10-year dollar loan, and if it will be somewhere at 12 or 15%, so higher than the yields which you make, therefore you can't leverage real estate in Moscow. This is also a reason why it is less interesting.
Although it's difficult to see a long-term trend when there's so much volatility, do you see within the domestic investors an increasing appetite for real estate? Because I think we're foolish if we depend on foreigners. The money flows in and flows out, and the Russian money tends to flow out. But is there actually more Russian money seeing and looking at real estate as a good long-term investment? Because there's nothing else.
As I mentioned before, I think there's an increasing interest of say, high net worth individuals, oligarch structures, wherever they are, who are looking at these things between 10 and 50 million. So they are looking at it, and I think with good reason, because it's still better to have a good building. And if you buy something inside Moscow, I think there's also the confidence among Russian investors that whatever you buy inside the third ring road is a very liquid asset. And therefore there you see more interest. And there's a very small investments from the pension funds. And I myself, I sold one building from Austrian investors last year to Blaga Sassayani, which is the pension fund of the Russian Railways in St. Petersburg. So they are now becoming very professional institutional investors. So there we see something. But my impression is that the funds they have for this sort of investments are very limited. And therefore, and I have seen so far mainly Blaga Sassayani being active here. So I think it will take a long time until you see more investors from the pension fund, and they should be the ones investing mainly. And it all depends to which extent they have the rights by regulation to invest in, and how much of their funds they can invest into real estate. So there is something coming, but right now, if money from Russia comes, it's mainly these private individuals. Yes.
On one of the slides, you had a point that one of the trends for the Russian real estate market is higher differentiation between higher quality and lower quality premises. And this is actually a view that I personally share, but if you can provide us some quantitative assessment of how it's been in Europe. Let's say you have same location for residential houses, lower quality, higher quality in the same location. What could be the price difference? Or say you have same A-class offices, but one is considered like super duper A-class and the other is like inferior within A-class. What could be the difference between these similar properties but of distinctively different quality?
Well, if I would look now at, say, for residential at the Berlin market, which I know best, when you have a very small amount of apartments which are sold for 20,000. Just recently they reached this per square meter, this pricing of 20,000. You would see a lot of stuff which is somewhere between 8 and 10,000 for the quality stuff, high quality buildings in good locations. And if you go a bit to the outskirts of Berlin and you have this panel houses built during the communist times, there for an empty apartment you would pay 1,800 to 2,000 euros per square meter. So this is for residential, so somewhere it is up to 9 times higher as well for the top stuff. And for office rents, I would say an expensive office rent in Berlin would be somewhere between 25 and 30 euros in the city center for a top building. And for a cheap building, you are somewhere at 10 euros per square meter, so it would be 3 times higher. Just as I mentioned it, I mean, we have here in the Class A offices in Moscow, I mean, we're in the central business district, for example, at White Square, you would still pay $800 or even more. That's what some tenants asking for still. In the top in Berlin, as I say, would be 30 euros per square meter, which is 360 euros per year. So we are still about 40% lower than in Moscow. So booming Berlin is still 40% cheaper than somehow depressed Moscow. So this, which might be also an indicator where we are heading, I think.
I'm just curious, who is selling those properties, who is selling those prime properties that can produce 12% yields in Europe? Are those people who just can get financing, or who is selling at such attractive yields?
I have to say already these are falling the 12%. This is of course mainly because it's leveraged. So you have leverage of 80% bank financing, which if you're lucky, you get at 1.5%. And if you buy the building then somewhere at 5%, then you're coming to this very high leverage yields. But it is all sorts of people who are selling. And there's, I think, some people thinking to slowly get out of the market as well, because they are skeptical if how long the party will go on, and this is a bit the main conclusion of the report as well, I think. My gut feeling would be that for the next 3 years, I would expect that things are stable still, and the main reason is here that I think that this is mainly driven by the European Central Bank. I would assume that interest rates will stay very low because you have Italy with debt to GDP of 130%, France with I think 100 now. If interest rate on their bonds would go up from 1% to 3%, there would be a high risk that their debt becomes unsustainable. And therefore, I think the central bank has to continue with their low interest rates, whatever effect this will have on overall capital allocation in Europe. And as long as interest rates are low, people are panicking. I mean, I see this in Germany especially, where to get their money, and therefore a lot goes into real estate. And therefore, I don't see anything changing. However, it's always difficult to make forecasts for a longer time, and therefore I would be afraid myself to buy stuff now, to invest at these low prices and keep it then aim to keep it for 10 years, because simply the situation somehow is not sustainable, I think.
Right, but I guess I was asking about other cities besides.
Yeah, but I think what I would say is in what you see right now in Germany, for example, is that more and more people go to the smaller cities. So you had firstly in Germany, you have 6 big cities: Munich, Frankfurt, Berlin, Düsseldorf, Hamburg, and perhaps Cologne. And now people go more and more to the smaller cities there. And look, for example, at student housing in Kiel and pensioner houses in Bielefeld, these sort of things. And also for apartments in the lower cities. So there, I think we will see now rising prices as well. And in East Germany, for example, there's a lot of coming. And the situation is probably similar in other European countries as well. So you see a catch-up of the B locations, B cities. And in England, for example, Birmingham and Manchester have been up quite strongly. And then the top locations stay stable, or in the case in London are rather falling. And Berlin is the only one which is catching up, therefore still rising. And then Munich is stable as well, I think.
Okay, yeah, so just one more point. I guess one of the surprising things I saw was Birmingham on that one slide. That's kind of a trend that you see continuing, sort of second-tier cities moving forward.
Yeah, and they mentioned this especially in the report, that there's a lot of people moving out of London and going into Manchester and Birmingham now because they are unsure about the situation in London.
Thank you.
Yes, the question if something similar is in Russia. I think in Russia it is enormously focused on Moscow. I mean, even when I had been marketing this office building close to Pulkovo Airport in St. Petersburg, which was rented to Gazprom on a long term, these very, very good quality asset. 60% of the investors we were talking to said no interest, we just do Moscow. And right now it's probably the same. But out of Moscow, if you would come and have, retail stuff, perhaps people might look at bigger cities in Siberia. But in general, they say, no, we're not interested. And then even, funnily enough, even the Russian investors are mainly looking at Moscow.
One clarification question about one of your last slides. With the survey of the market recovering in how many years? Just to understand what the terms are these transaction terms? Are these like number of transactions, volume of transactions, prices in rubles, price in hard currency, or whatever?
Well, I understood pricing in dollars, or these yields there, which were 8.5% for offices in Moscow. This was somehow, when we had these 8.5% for Class A offices in Moscow before 2007, and we had them again in 2013, and that's somehow the best we had. And that's how I understand the question.
And just continuing on this aspect, a lot of offices or warehouses were built in Russia using dollar financing, and rental rates were linked to US dollars as well. But this is not continuing anymore. So how are these companies dealing with their US dollar nominated debt? Have they restructured it or defaulted, or what happened there?
I think that's the key question in all this here, also to come back about the distressed assets. because normally you would expect that people, I mean, indeed, most of rents now are being concluded in rubles. And depending on the behavior of the rubles, people must have problems. Anyway, even in dollar terms, they have gone down. I mean, there in White Square, you were talking about the dollars before, and now we are at 800. So if they build the financing on this $1,100, they must be in problems now as well. I think that the main reason is that banks are extremely hesitant to create any problems, because once they really would call in the loans, they would have enormous amount of problems as well. So they are open for all sorts of discussions, just to try to keep to avoid this debt becoming bad debt. But I have not seen so far any sale because of these issues. And the issues must be there. I mean, I've seen big issues at a couple of investors who are not able to service their debt and just somehow try to get along. The question is if this is sustainable for a long time, or if at some point of time somebody will take out the plug.
As you know, over the last year, a bunch of state-owned corporations or quasi-sovereign funds like, I don't know, Rostec or Rostelecom announced their plans to monetize their excessive real estate assets and to create so-called special funds. Do you see any potential there? Is there any interest from banks or from other investors, from pension funds, to participate in those funds? And do you see any reason for that?
As I mentioned before, I think the pension funds, they might be interested, but they have rather low money available. So they might think set up their own vehicles along these lines. I don't expect a lot of money to come from them. I mean, theoretically, it should make sense to come for say, Mid-Eastern sovereign funds to invest into this sort of vehicles. But I'm skeptical. I think these Mid-Eastern funds, they rather would like to acquire assets themselves in order to control them. And here, the Russian banks, they don't have the funds right now to invest into this sort of thing. And otherwise, there is not, the capital market is too small in Russia still to have a strong investor base for this sort of vehicle. So, and we had looked with one of our clients to set up this sort of vehicle as well, but I'm very skeptical if we have enough demand for it.
Yes. During the presentation, you mentioned the current boom, I think, in the German market when for retail investors, flowing money into real estate funds. I think it was an article yesterday that Sberbank Asset Management launched the fund, which basically owns the title for a storage facility in Novosibirsk, and they do offer it to retail investors. And so I was just wondering, what in general you would think of this idea, developing here in Russia, and what were actually the factors that, led Germany to, developing these real estate funds for retail investors?
I think it's just a question of time, and I haven't read this article, but I think in general, if Sberbank would be the one who would have to push these things. Now, if they push this this fund vehicle, they of course it will go to the detriment of the money there, of the deposits. So they have to say, listen, we are ready to forgo these deposits, and then to market it actively. I'm not sure if I had started this, if I would have started with some logistics in Novosibirsk. I think if I had been Sberbank, I rather would then take one of the big buildings here in Moscow and say, listen, here's this thing, this one, for example, and we put it into a fund and sell it to investors. It would be easier to market, my opinion. It's all a question of time. I mean, in Germany, these things are marketed now for 70 years to the public, and it has taken a long time to build this up. And before joining PwC, I worked for UFG for the asset managers, sitting here as well. And there this was in 2007, 2008, and I led the real estate operation, and we thought about these things as well, and we UFG even was building up a little network to market their funds. But this is an uphill struggle, really. I mean, if anybody can start it, certainly is Sberbank, but they would have to be very active in doing it. But if they do it, I'm happy to hear that. Because I think this is really one of the biggest issues in Russia, is that the domestic capital market is very small. And I think it should be really a priority of the Russian government to push more for this, to have transparent players on the capital market to become a strong force here. This would be good for the country, certainly.
Do you have any thoughts on the Chinese property market?
No, I don't have a clue about China, I have to say.
And one more question. Actually, you mentioned that retail clients in Europe are basically leaving deposits and putting money to funds that are investing in property markets. But in that case, how banks are actually substituting this money that depositors are leaving the banks, and they still need to provide loans for these transactions. And so the major financing is coming from sales from banks. So what are the sources of this money?
The problem is simply that the monetary mass I think has increased 3 or 4 times in Europe. So banks are flooded with money, and now if they put their excess money into the central bank, they have to pay to the central bank, and that's why now they charge the depositors for paying for the deposit as well. So the banks, on the one side, they have enough money. At the same time, due to all these Basel regulations, they are more restricted in the way they can give out loans, and therefore we don't have enough loans, and therefore they are just happy if they get rid of these deposits. They have too much deposits now.
But still, it means that they are relying on central bank financing, correct?
No, they have too much deposits because there's simply so much money created, so they have more deposits than they need for their loans.
And could you please elaborate a bit on internal rates of returns on construction projects between different countries?
I'm not sure how much you would get in the other European countries. In Germany, I know because I'm involved myself very much. I don't know how this would look like in the other countries. I mean, normally, what I see for yields, I think, for example, for loans, that Belgium, which I know a bit, or France, are a percentage higher than Germany, as also the government bonds are 1% higher than the German bonds. But as for developed, I don't know what yields you have these. I just happen to know the German market quite well.
Yeah, but what about the German market?
I mean, as I say, for the development yields, you are somewhere, if you give, the development yields are in excess of 15% for the equity investor. And if you come in as providing mezzanine loans, you are somewhere between 10 and 15%, which you get.
And what is the normal leverage for this type of projects?
75 on average, I would say, you have leverage on development projects.
Thank you.
Continuing on this slide with the relative yields, so we can see now this huge 3 percentage point gap between property yields and bond yields. So potentially, you can see this arbitrage opportunity, say gaping arbitrage opportunity. How long do you think this will persist? Or do you anticipate this gap to be closed sometime in the future, like it was, let's say, between 2007 and 2008, when there was no gap essentially?
You are asking the right questions here, I think. I mean, if you look at it, how can it be closed? I mean, either these ones go up, but this would create enormous problems for France and Italy, or these ones go down. And probably my feeling would be that rather the property yields go down, but this as well, I mean, as for a real estate investor, I think it doesn't make sense anymore, because you're buying stuff then at a 2% yield, with the risk that when you try to sell it in 10 years, the yields are somewhere at 6 or 7%. I would find this frightening, but it can well be that market goes in this direction, and I'm a bit too pessimistic and should buy buildings in Berlin right now. It's difficult to say.
So essentially, you're saying that people think this gap is not sustainable, and that people are not buying property at lower yields just because they think that in, let's say, 3 years, the soft monetary policy will go away?
I think the main essence of our report is that people think that this is not sustainable, and they might think it might fall a bit, but somehow I think the professionals are worried by all this, and therefore become a bit more pessimistic. Now on the retail investors, I'm not that sure. I mean, if you look at the housing market in Germany. There's still enormous demand and prices just growing every year by 6 to 10%, which is a lot. Right? Now, fair enough, one has to say that German residential rates have been almost stable for 25 years. So while everybody else went up, they have been more or less stable. And therefore, if you compare this, which I mentioned, say $10,000 for a prime asset in Berlin to London, this is a joke, of course, and that's why at least in Berlin they still go in. It's difficult to say. I mean, I stopped buying apartments in Moscow when prices were at $2,000 per square meter for Kommunalka because I thought it's not sustainable. And then they went up to 10,000. So it's always difficult, I think, when you stop to invest.
Hiya. So you said you're a specialist on a Berlin market. So can you tell us a couple of nice picks with regards to where to invest? Would it be, let's say, residential, hotels, maybe care houses? So what would you think in Berlin is, the most interesting area for investing at this point of time? Maybe give us a little secret of yours. Thank you.
I mean, what I'm looking at right now is residential development, which is close to the. I mean, in Berlin, you have you have the Sadovik Kalso, which defines somehow the borders of the inner city, and this is in Germany, in Berlin, the S-Bahn ring, which is the Circle Road around Berlin. And there we're looking right now at a development project very close to the Circle Road in a nice area. And this is a mezzanine loan where we're talking about 15% might be negotiated down to 12.5%. And this is a big project which then will be sold to some institutional investor. And I think here, knowing that institutional investors are crazy to buy these things, so once the city has an interest to build this stuff, because there's an enormous influx of people to Berlin already before the current refugee crisis. Now, you have every year 40,000 to 50,000 people coming to Berlin, so there's an enormous demand for residential. Therefore, the city is ready to allow to build for whatever is possible. So this project there, I like, because it's just a short time horizon. Otherwise, I think what I would do is still looking at the good area. I mean, in the areas in Berlin are much more different than in Moscow. You have the Zalataya Mila over there in Kropotkinskaya and Patriarchy, but in general it's more homogeneous. And in Berlin, there's enormous differences, also because some areas got totally destroyed in the war, others were kept. And there are some cities like Schöneberg, for example, which has enormous potential to go up. So you go around and then look for stuff which you think. We have others like Prenzlauer Berg, which I think are somehow at the peak. I would look at for residential inside the Circle Road, and then for those areas which are not fully developed, like Prenzlauer Berg or Mitte. I would look at offices as well, and there perhaps somewhere, when you have one of the main drivers in Berlin is this IT sector. I mean, we have in Germany for all these startups, and apparently this time it has overtaken for the first time London as well. So it's the biggest amount of money coming into one city. And these people are always looking for this cheaper loft offices. So here also might be a good idea to look for these sort of things for offices in B locations. That's just out of my head the first answer to your question.
So if there are no more questions, let me thank Holger Müller for this profound outlook into the real estate market in Russia and in Europe, and for taking your questions in such a detailed way. And let me announce you that in next week, please pay attention to the major event that we are going to hold in Moscow. It's an annual forecast dinner, actually, which hopefully will extend today's pace of the conversation to find the outlooks at different parts of the financial markets in Russia and in Europe. So we are going to have quite specialized, focused speakers in various areas. We will present you the latest survey by the CFA Institute, as well as have speakers from the Central Bank of Russia, from a top recruitment agency working in the financial industry, from energy sector specialists, and several key people who will definitely be of interest to you, trying to give an outlook into the year to come. Hope to see you next week and at our future events. Thank you a lot, Holger, again.